So you just started your first job. Congratulations. That first payday feels great, doesn't it? So you just got your first paycheck and you're feeling rich. Well, until you looked at the pay stub. Where'd all your money go? And who's FICA? And why is Medicare taking all of your fund money? Today, we're decoding your paycheck stub so you know exactly who's taking your money and why it matters. It's actually not all bad news. So let's check it out, shall we? Hey everyone, this is AJ, your ace in the hole, and welcome to the channel where we super simplify personal finance, providing tips and life hacks for young adults and others based on real life experiences to help kickstart their financial journey. Whether you're just getting started or a parent looking for some ideas, either way, I'm here to help stack the deck in your favor. So let's get right to it. So in today's video, we're going to acclimate you with an overview of all the things you might see on your paycheck stub. Depending on the company, it may be quite simple, or it may have all sorts of things listed, which can be a little intimidating at first. But we're going to walk you through the most common items to put you at ease and help you understand the value that those deductions provide, despite not feeling so great at the moment. So first things first, we'll look at gross pay versus net pay. The first thing you'll typically see on your pay stub is called gross pay, which is your total top line earnings for the designated pay period, before anyone takes a bite out of it. Then there's net pay, or your take-home pay, which is what actually gets deposited into your bank account after all deductions. I know it kind of feels like ordering a meal deal at the drive-thru and then realizing when you get home, you only have the burger. But hang in there. There's more to the story. Now that we touched on gross pay and net pay, let's talk about all those deductions. There are numerous payroll deductions that may or may not appear in your pay stub, based on your company, your state and location, your personal situation, and other optional selections as well. We'll first start with the primary deductions you typically see first. We'll start this off with FICA deductions, which stands for the Federal Insurance Contributions Act, established back in 1935 as a part of President Franklin D. Roosevelt's Social Security Act. These are mandatory deductions which cover Social Security and Medicare. First, Social Security, sometimes referred to as OASDI, which stands for Old Age Survivors and Disability Insurance, helps support retired individuals, people with disabilities, and families of workers who've passed away, and ultimately becomes your money to draw from once you reach Social Security age. This currently equates to roughly 6.2% of your wages up to a yearly cap. Medicare, on the other hand, supports health care for people over 65 and those with certain disabilities. Medicare deductions equate to roughly 1.45% for a total FICA deduction of 7.65% of your wages. So while it may seem like this money's vanishing into the ether, think of FICA taxes as funding these federal programs that support millions of Americans and ultimately your future once you become eligible to receive these benefits during retirement. It's important to note that your employer also matches these deductions, contributing an additional 7.65% for a total payment of 15.3% to these federal programs. Here's a brief example of how this breaks down. In this example, let's assume you earn $1,000 a pay period. You would pay $62 in OASDI or Social Security and $14.50 to Medicare for a total of $76.50. Your employer also pays the same $76.50, so the total FICA paid on your behalf is $153. Next up, there's federal withholding tax. This is your actual income tax withheld by your employer and paid to the IRS, or the Internal Revenue Service, to cover your federal income tax liability. The amount is based on your income, your tax bracket, and also the info you provided on your W-4 form, which we'll touch on in a moment. When you file your annual tax return, the amount withheld throughout the year is credited toward your total tax due. If too much was withheld, you get a refund. If too little, you owe the difference. Ideally, you want zero taxes owed and zero taxes refunded, which would indicate a perfectly planned tax year. Although, don't worry too much, as this rarely ever happens. Now, quickly back to that W-4 form. The W-4 form is an IRS form which you will fill out when you start a job. It tells your employer how much federal income tax to withhold. It includes your filing status, so if you're single or married. It also includes the number of dependents, for example, if you have any children. It includes any additional income or deductions you want factored in, as well as any other extra amount you might want withheld. All of this factors into how much tax is withheld from your paychecks. I have the official IRS W-4 form linked below if you want to check it out. Now, wrapping up the income tax section, you'll likely also see state or even local taxes depending on where you live. Most states also require income tax, but there are a few states, for example Florida and Texas, that do not impose state income tax on wages. But before you pack your bags, don't get too excited. These states generate tax revenue in other ways, such as higher property or sales taxes. Now, where were we? Oh yeah, on to healthcare deductions. So if you enrolled in employer-sponsored health insurance, which includes medical, dental, and vision, those premiums are also deducted directly from your paycheck and are pre-tax deductions, meaning they reduce your taxable income, all while helping with your medical coverage. An important point related to this coverage is that in most cases, employers help subsidize this cost by paying a portion towards your coverage as well. So while this might seem like a large deduction, keep in mind your company is likely covering a portion for you as a company benefit. How much they cover can vary by company, but you're likely not covering the full cost all by yourself. Now, moving right along, we have retirement savings. Many employers offer retirement savings plans such as a 401k or 403b. Contributions to these plans also are usually pre-tax, which means they also lower your taxable income now while helping you save for your future retirement. Typically, you choose a percentage of your paycheck you want contributed to these plans. Additionally, your employer might even match a portion of your contribution up to a point, which is essentially free money towards your future. For example, if you contribute 3% of your paycheck to your 401k and your company offers an employer match of 3%, using the earlier example of $1,000, you would contribute $30 per pay period, and your company would also match that, contributing $30. In essence, doubling your retirement savings. Again, 100% free money. One quick personal recommendation is that you should always at least contribute up to the max that your company will match to maximize this benefit. Otherwise, you're leaving free money on the table. There are also many other deduction electives you might choose depending on the availability at your employer. You might see things like various insurance options such as life insurance, disability, or accident insurance, as well as HSA or FSA options, which are health savings or flexible spending accounts for medical expenses. These are optional, but are very useful as they offer additional financial benefits, especially HSA plans, which are incredibly tax efficient. We'll be making a future video specifically on HSA plans, so be sure to stay tuned to the channel for that. Finally, there are some much less common deductions that may show, again, depending on your company, location, or personal situation. You might see things such as union dues, wage garnishments such as student loan collections, transit or commuter benefits, as well as other company perks such as gym memberships. These vary by job, so don't freak out if they pop up. Just know what they're there for, and by all means, don't be shy. You should always question unfamiliar deductions with your company if any appear to be in error or need further explanation. So that pretty much wraps up the many deductions you might see on your pay stub. From here, your stub might also show how many hours you've worked, overtime, how much paid time off you've used, such as vacation, personal time off, or PTO, and any sick leave hours. You will typically see all of your hour and monetary totals for the current pay period, as well as ongoing year-to-date totals as well. This tracks your total earnings, total taxes paid, and total deductions since January 1st. This is super helpful for budgeting, tax planning, and even loan applications. It's kind of like your financial progress report for the current year. Finally, you should always keep copies of your pay stubs. While there's no federal law that requires you to keep your pay stubs, it's a smart practice to keep them for things such as verifying earnings or hours, disputing errors, applying for loans or rentals, and for filing taxes. A best practice is to keep pay stubs for at least 1 year or until you receive and verify your W-2 form, which is a year-end tax document provided by your employer that shows how much you've earned and how much was withheld in taxes from your paycheck. So that covers an overall view of a typical paycheck stub and the many deductions you might see. While it might cause a little angst at first, you can see that most of these deductions are put to good use for both your current and future self, especially if you're contributing to the many savings options. Many of them can have a significant benefit to your current tax situation as well as your future financial health, especially considering the many company match options that may exist. We're going to get into some of these savings options in detail in future videos, so be sure to like and subscribe so you don't miss out. And most importantly, if you know anyone that might be interested in this type of content, please share our video. It's our goal to help educate and arm our future generations with the info they need to build their own financial success in life. If you're interested in more info regarding this type of content, please check out these videos here, and I hope to see you in the next one. This is AJ, your ace in the hole. See ya!